Well, thank you very much, Kevin. Thank you to the CSEG for having me. It really is a privilege and an honor for me to be speaking to you. Coming back to speak to geophysicists is like a homecoming for me. And, Kevin, what you didn't mention is that if you had asked me 25 years ago when we were working on field crews whether or not I'd be doing what I'm doing today, I would have said you're crazy. Being originally really a very technical, geeky kind of guy, having now driven my career into philosophizing about the world's energy problems is something that I would have never dreamt of. Nevertheless, it's extremely rewarding, and I have to say that though I do not practice geophysics on a daily basis, I have to tell you that the training that I received as a geophysicist and the analytic discipline has been absolutely fundamental in my ability to interpret the world's trends and where we are going. The title of the presentation today is Beyond 1,000 Barrels a Second, and that was what was billed in your program. I've got a bit of a double header for you. It's Beyond 1,000 Barrels a Second and What's Wrong with Canadian Gas. And in fact, it may be more appropriately termed more of a bait and switch, because I'm going to talk much less about Beyond 1,000 Barrels a Second and much more about what's wrong with Canadian gas. And I decided to do that because, contrary to public belief, the natural gas business in this province is in recession right now. And I think we need to talk about that. I think we need to understand what's going on because it affects the competitiveness of all our businesses here. Interestingly, however, the two subjects are very much related. What goes on in the world, and particularly what is going on the other side of the planet, has tremendous implication to our oil and gas business here, and we need to explore that. So, I will get into the subject matter, but I will first just give you a little bit of a preview of, exactly what it is I do now that I am not picking seismic sections or processing data. I work for ARC Financial Corporation. We are investors in the energy business. We're an Alberta-based company founded in 1989. We're the largest energy-focused private equity firm in Canada, which means we are providers of equity capital to energy companies and dominantly oil and gas. We manage $1.9 billion of capital. We've invested in over 140 companies, so we really feel we understand what it takes to grow an energy company. We're a large stakeholder in Alberta's financial community, and though our roots are highly grounded in Alberta, we are now very much a global company investing in oil and gas and beyond in things like renewables and other types of energy infrastructure as well. So my job really is to understand what's going on in the world trends of energy, and translate those into investment theses and ideas on which my firm can direct their capital to. Well, as I said, I've migrated my career into understanding the way the world consumes its energy, and really one of my passions now is to sort of question, well, how is it that we've gone from different sources of energy, like from water mills to nuclear power? How is it we've gone from coal to oil to natural gas, and so on? What is it that drives these sorts of transitions? And my book talks a lot about that, and I'm not really going to talk very much about the book at all. But I'll throw up this chart here to start with, which is the world's energy mix today. Starting at 1965 to 2006, vertical axis is consumption in millions of barrels of oil equivalent per day. At the bottom is hydroelectric power, which is a relatively small fraction of the world's energy supply. Once you dam up all your rivers, there's not much more than you can do. Oil is still the dominant commodity out there, followed by coal. Nuclear power, which is really the last really innovative large-scale supply source that society embraced, really emerged around 1957, so it's been 50 years ago that we've had what I call in my book a magic bullet that has come in to be able to, in a large-scale manner, provide an energy solution at a time when we had crises, in the 70s in particular. And the top layer is natural gas, and we're going to be talking more about that. If you direct your attention to the very top right-hand side, you can see that the world's energy needs are starting to grow at rather an accelerated pace. There's a lot more oil and a lot more coal being used. And that's basically what I would call the second industrial revolution, which is what's going on the other side of the world. And I have a whole presentation on that, but time really precludes me in talking about that. But I will show you a couple of interesting vignettes and give you the conclusions of what happens. Now, as I said, it's sort of my role to interpret how it is that society embraces new energy systems, and what are the catalysts of the introduction of the new sorts of energy systems, and how long it takes for those energy systems to come into play. One of the better examples on a national level is what happened to Japan, and I highlight this in other countries in my book. Again, on the same time scale, 1965 to 2006, I've got an all-energy consumption chart. And so let's take a look at Japan. Between 1965 and 1973, this was sort of the booming post-World War II period, where Japan was following the same pattern as every other industrializing nation follows. And that is, they first start out with hydro, then they rely on coal and oil to boost their economies into the industrial age. So every other country in the OECD country of 30 countries, so that would be like the United States, Canada, the European Union countries, Korea, Japan, and Australia, they all follow the same pattern. You dam up all your rivers and you use whatever coal you have, and then you use oil as your booster rocket of economic growth, until that pattern is no longer sustainable. Something gives either on a regional level or on an international level, and you have to make things change. So all of the OECD countries, including Japan, underwent that, what I call breaking point in my book, in 1973 and 1979 with the oil price shocks. And it was at that point where it was rich with government policy that drove change, be it in the United States, things like you can only drive 55 miles an hour, or you can only use certain kind of fuels in your power plants. In Japan, they said, for instance, that we will not consume any more oil going forward than we do today. So they've held to that promise. You can see they don't consume any more oil today than they did back in 1973. And it's during these periods of turmoil and breaking point that diversification of energy systems starts to occur. So if you have that option, then you branch out. And in the case of Japan, they branched out into more coal, embracing nuclear, and actually they were the pioneers of liquefied natural gas. They were the pioneers of liquefied natural gas in the 1970s. And so today, Japan, like all other OECD countries, has a diverse mix of energy sources, primary energy sources, hydro, oil, coal, nuclear, natural gas. Now you may be wondering why I have not put renewables on there. Well, number one, because there isn't really a long history that's documented of renewables. And number two is it's about 1/100th of that stack, so it would be barely visible. All of which goes to a point that I like to make in many of my speeches, is that people need to understand the scale and the magnitude of the issues facing the world today. Right? If you think about nuclear power as our last, what I would call magic bullet, a technology that had tremendous scale that could be implemented actually relatively quickly. Generally in the world, yes, I know we've had 3 Mile Island in Chernobyl, but that last magic bullet from 50 years ago has only been able to penetrate 10% of this stack. Okay, so you can see that when you talk about things like solar and wind and biofuels and all these sorts of things, all of which I think are great, they just don't really have the scale, and people don't understand the magnitude of the multi-trillion-dollar infrastructure that's already in place to deliver the 5 primary fuels we have. Okay. Well, I could say a lot more about that, but I'm just going to leave that as is. For the purposes of today, you need to understand that there are these points in here, energy history, that actually don't come along too often, where we're in these breaking points that we have to sort of rationalize. How is it we're going to continue to grow our energy needs? And from the perspective of countries like Japan, the United States, and the European Union, frankly, we're rather boxed in. It's the 5 primary fuels and a smattering of the renewables that are coming online. Right? It's a whole separate subject in terms of where we in the West or the advanced economies are going to grow. But let's take a look at sort of the industrializing economies of the other side of the world. If we look at China, where they are today on the same scale. So they too are following the very historical pattern of, okay, you dam up all your rivers, including the Yangtze and the Three Gorges. See that even that is not a very large part of the energy mix. You aggressively use oil, and in the case of China, because they have a fair bit of coal and not a lot of environmental restrictions on that front. So coal is being used very aggressively to boost their economy. And if you look in the last 5 years on the right-hand side of the chart, you can see how fast their energy needs are growing and how intense it is. And it's not likely to let up, as I'll show you in the next slide. Now what I want to do is sort of pull the same slide back, okay, and put it to the scale. At the very top of the chart, you can see the consumption level of the entire OECD, the 30 industrialized countries, and the projection path that China is on. Now I haven't done sort of you may think all I've done is taken a ruler and drawn this sort of red dotted lines going straight up. No, actually behind it there is a little bit of analytics behind that in terms of how that is going to emerge, but it's not. This is not an aggressive, or say it's not a unrealistic scenario. And I had the fortune of spending a month over there this last summer to see firsthand if this is true. Like I've been analyzing numbers since I've been doing geophysics 25 years ago. I'm trained to see anomalies, and I look at these numbers and I say, I've never seen anything like this before in my life. How can it be true? Well, when you go over there and you see what's going on, I actually came away and said, you know what, my numbers may be actually a bit conservative. Right? So if you put this in the context of an industrial revolution, which is, I believe, the appropriate context, and the last industrial revolution started in really the 1779 or so. This is not only about China, but it's about the entire, Asia-Pacific region, all the way extending to Asian subcontinent, and even into places like Eastern Europe and Russia and other places where there is a very aggressive industrialization and a desire to achieve the standard of living that we in the West have achieved over the course of the last 30 to 50 years. Okay, that's what's going on. And to do that requires a tremendous pull on the world's energy resources. Okay. Is this sustainable? Well, there's a number of antagonistic things, including the environment and things and the economy and so on, but I believe largely it is sustainable. And yes, we may have some economic slowdowns and ups and downs, but the trajectory will remain intact. The trajectory will remain intact. It's just maybe we have some ripples in it. And so the question is, well, how will this go? Well, there's already a breaking point going on over on the other side of the world. And so the question is, what will it look like? Well, given that we're boxed in with the scalable primary energy sources, it'll look probably something like this. Okay? And again, there's some calculations that have gone on behind this, but that's largely what it looks like. The interesting one here is natural gas, and I don't think the scale here does it a lot of justice, but I'm going to show you a slide here and a couple slides that show you sort of the tremendous pull on natural gas globally that's starting to emerge as the other side of the world sort of undergoes their own classic breaking point where, okay, we can't pull on hydro anymore. We've dammed up all our rivers. Oil's got all sorts of issues. Coal has got environmental issues, and it's not as flexible as natural gas and oil. In other words, you can't shovel coal into your car to drive and things like that. So necessarily there has to be a diversification, and the diversification is underway. I think I'm going to sort of largely leave it at that. I will show you a little vignette of what I'm talking about here, and then show you sort of the global demand for gas, which will then lead into a discussion about what's going on over here. Okay. So from my trip, it took a lot of time. I'm sort of an amateur photographer as well, so I took 3,000 pictures over there and came back and sort of looked at them and put them together and made a little energy travel log. And so these are a handful of pictures from that energy travel log. If you go into rural China, which we were fortunate enough to do, you will see a lot of these things here, which are basically stoves. Right? If you've been to rural China, you will see that everywhere you go, people do just-in-time cooking. Once they go to the market, they get their food, they put it on this stove, and they start cooking it. Okay. The stove is, on the inside, it looks like this. It's got like a cement kind of wall to contain the heat, and basically what you put in the stove are these coal, I'll call them hockey pucks, but they're a lot bigger, and the holes that are drilled into it to facilitate the burning of the coal. Now, this is really low-quality coal that's quite dirty to burn. And if you consider that there's 700 million people in rural China that is doing this, it's a staggering amount. And there's 550 million people living in the cities that are going sort of beyond this. And, when I get back to that notion about scale, we really don't have a good appreciation of the scale of the energy intensity and the consumption. So the coal delivery person basically will come by and sell you your your coal, which you will put into your oven and stoke the stove and make greenhouse gases and cook your food. So that's what it looks like. There are, however, signs of change, and sort of poking my camera around into places that probably shouldn't be, somebody's kitchen. Anyway, I took this picture here, and if you look around, you start to see that there is sort of signs of change going on over there, that modernities are starting to creep in, and so there's a gas grill. And underneath the gas grill on the right, you can see that there's a gas cylinder. And in fact, there's sort of the emergence of gas cylinders. And in Hong Kong, the transition has happened over the last couple of decades, which is really a harbinger of what I believe is going to happen in mainland China. So all of which is to say, so here's a vignette of the transition. I mean, a lot of people are using coal, but there is sort of a transition to gas that's occurring. And it's not only in cooking, but it's in also anywhere else that use gas. And there's I've sort of highlighted this, there are people who are selling the gas grills and so on. So instead of a coal delivery person, you actually are seeing these people that are wheeling around now gas cylinders for people to use for cooking and even heating potentially. So that sort of gives you a bit of a vignette of the sort of substitutions that are taking place, this idea of the breaking point and diversification of the fuel. This is a really important chart. So this is world natural gas demand by region. Now I've got consumption in billions of cubic feet per day on the vertical axis, and time over the course of the last 20 years on the horizontal axis. I'm actually going to start you off in the middle, the green, to North America. And I'm going to come back to this as I talk about Canada and North America. Basically, North American gas demand is flat. Right? It's flat. It hasn't really changed all that much since the last 10 years. That is highly unusual relative to the rest of the world, like Europe and Eurasia, where you can see that the blue line at the top, the demand for gas is growing rather aggressively. The demand for gas in Asia Pacific, including China, is really starting to actually accelerate, as is the Middle East. So the picture abroad is quite a bit different than the picture over here, and it's important to recognize. The incremental gas demand for the world as a whole, or the rate of consumption growth, is running around 8 BCF a day every year. So we need to find or bring on 8 BCF a day more production every year, but that's accelerating. By 2010, it'll probably be around 10 BCF a day per year. Okay. And it may even be more aggressive than that, depending on how places like China have their breaking point going forward. So it's very aggressive. It's a very aggressive demand profile around the world. And I think that this is a story that is going to start to become increasingly important going forward. And leads quite nicely into the other presentation that I want to dovetail this into, which is really what's wrong with Canadian gas. Okay, I mean, we've got a situation in the world where actually the price of oil, I think this morning, was on the verge of touching $85. A year ago today it was $60. So it's up $25 in 1 year. $25 in a year. And I think it's going to go higher. Okay. Just the politics, the supply-demand balance, the tremendous pull from the industrializing countries. That story is, I think, a very bullish story. In fact, the rest of the world's going berserk, whether it's oil or gas. But what's going on over here? I mean, you drive by Red Deer and 2/3 of the fleet, it seems, is sort of parked, and nothing's going on. So I think it's really important to understand what's going on here and what is the future of our basin and what it is that geophysicists and other technologists, geoscientists can do. Well, let's take a look at the history of natural gas prices. So this is over the course of the last 10 years. Okay, the vertical axis is price in dollars per MMBTU. This is the price in the U.S. at the Big Henry Hub benchmark location. So I'm going to gray this out and just give you sort of the eras of natural gas over the last 10 years. So this is basically what I would call your 1990s baseline. The price of natural gas in North America actually averaged $2.10 or so from pretty much all of the 1990s. This price spike here in the winter of 2000-2001 was the first storage deficit. In other words, the storage was draining rather quickly. The market got very excited and drove the price up to, at that time, remarkable levels of $10. It didn't really last. And so this was the first and actually the last storage deficit. This spike over here in the winter of 02-03 was a momentary cold spell that got the market excited. There were some aggressive withdrawals from storage for a couple of weeks, but it didn't really last. The broader trend that's important is this one here. This is basically gas prices piggybacking on rising oil prices and also simultaneously a maturing gas supply. In other words, supplies in the continental North America actually struggling to keep up with declines. In fact, production was going down during that period, and particularly in some of the major basins in the United States. I'll come back to that. These were your hurricanes, and there's actually two peaks there. There's Rita and Katrina, which drove the prices into the stratosphere, though that as well did not last very long once the production came back. And that's really the key. The production came back rather hard, and this is a supply response to actually the big prices. And it's a supply response to new technology, as I'll show you. Here, and the step up is a bit exaggerated, but with $25 rise in oil price, it has been dragging the price of gas up. Were it not for that, our gas prices would be even weaker than that today. That's the story that's largely representative of the continent because it's the big major hub in the United States. But here in Canada, there are other factors at play. This is the last 12 months of gas prices, priced in Canadian dollars per GJ. You can see the declining price starting around February. A large part of this is actually due to the rising Canadian dollar. We'll come back to that. There's been a pickup on the back of the Henry Hub price, which is on the back of the rising oil price, and the approach to winter, which always gets the markets a little bit excited. But it's at $5.60 a GJ, hardly anything to get excited about here, and certainly not sufficient enough to really get the equipment back to work in any meaningful way. This really is the tell-all chart because, after all, it's not only about price. Okay, it's really about profitability and the netbacks that the producers realize. So on the vertical axis here, I have cash netback, Canadian dollars per BOE. Okay. And the last 3.5 years of history. So this is basically a synthetic model that we've put together. What does the average Western Canadian oil producer and what does the average Western Canadian gas producer realize in its netbacks in terms of the average price they realize at the wellhead and the average op costs and et cetera, et cetera. So the cash netbacks at the wellhead look something like this. Oil has outperformed natural gas in nearly all instances except the latter part of 2005 where we had the hurricanes. Today, the crude oil netback is around $35 a BOE, but the gas is only $15. $15 a BOE, and your F&D costs are over $15. It's like basically you're not making any money. You're just not recycling at all. The recycle ratio is less than 1 to 1. So, on a very simple answer to why the equipment's not working, there it is. It's just not economical at this current cost structure and the current pricing to go out and send that incremental rig out to find the natural gas. Oil is a different story, but oil, as you all know, is more difficult to find. We've been exploiting it for almost 150 years, actually, and it's just a lot more difficult to find the oil. But the economics on the conventional oil are generally better, which is why the oil completions are up, but the gas activity is substantially down. And there it is. These are the gas well completions. Now, the rigs, there's only about 300 rigs working. A couple of years ago, there was 600 at this time. So the utilizations are very low indeed, and I'm sure many of you sort of feel that. So we've got 600 completions per month right now, which is as low as it's been sort of in 2002 when we had a bit of a price dip. And, mid-90s is where it is. So this is a bit of a leading indicator of what's to come on the production side. If we look at Western Canadian pipeline receipts, which is pretty much a perfect proxy for overall production, it looks something like this. So the volume in BCF a day on the vertical axis, and we've got time, about 6-7 years of history there. So if you look from 2002 to 2004, there was a bit of a decline of almost a BCF a day. That was because the prices were really quite low in 2002. And we had some issues with the pipelines and the differentials, and the prices we were realizing here were not good. The economics were poor, and we did have a slowdown. Well, the declines kicked in rather quickly, and the production went down. The period between 2004 and 2006 It's very interesting. Of course, this is when the record levels of drilling activity started to pick up. Right? Record levels of drilling in that period, particularly in 2005. In those 2 years, there was $40 billion worth of capital expenditures targeted towards natural gas, and all we got for it was basically a 1 BCF a day boost. Right? We got a 1 BCF a day boost, and sort of you can kind of see it's sort of struggling to get up there. And it peaked sort of in spring of 2006, and then now in mid-2006, the high costs and the drop in prices started to take its toll on activity, and the response has been pretty quick. So the trajectory for production now is very predictable. It's down. It's going down around 0.5 to 0.7 BCF a day per year. And that's likely to accelerate because this recession is actually considerably more severe than it was in 2002, and the decline rates are actually higher. So that's probably going to accelerate to 0.7 to 1 BCF per day per year if things don't reverse. Which is rather interesting because you say 1 BCF a day, well, how much royalties does 1 BCF a day kick out at current prices, current depressed prices? Well, if you do the math, 1 BCF a day loss translates into about $400 million lost revenue, lost royalties, right, at the current royalty structure. So $400 million, like we're already down $400 million from the peak. This is going to accelerate. It's going to be 800 by the end of 2010 if this is left unchecked. So, this whole issue with the royalty regime, it's our fair share, but share of what? It's a share of a shrinking pie unless the economics improve. And so now we need to understand, okay, are the economics going to improve even if the royalty structure is applied, yes or no? So let's take a look at that. So what is wrong with Canadian gas? We have to answer that question first before we get a sense of whether or not things can improve or not. Well, number one is flat demand. I already showed you that chart. I'll come back to it. U.S. supply response, LNG, distant and concentrated markets, cost inflation, the Canadian dollar, and policy shocks. Okay, let's take a look at them. Flat continental demand. I'll sort of spare you all the analysis and just tell you that there's 4 major demand markets. The commercial, those are your high-rise buildings and hotels and convention centers like this one. Next to the right is residential market. The power generation market, where they use gas-fired power plants, and the industrial market for making petrochemicals and fertilizers and things like that. So, as I said, in summary, this is what's been happening. Commercial has been going down a little bit the last couple of years, as has residential. Now, that's a little difficult to see if you just look at the numbers, because it's highly, highly correlated to weather. Okay, so what we've done is actually I can use the word deconvolved, maybe, right? The weather out of the time series, and sort of normalized it, and tell you that if you just assume sort of a constant weather, maybe that's like flattening our horizon, I don't know. So you can see that actually commercial is down. Why should we be surprised when prices go up? There is some tendency to move towards conservation. And new buildings, well, they use much higher efficiency furnaces and things like that, especially in the residential market. Okay, so, it's not really huge, but it is down. Power generation is up, relatively big, and is going to be rising, in my opinion, much faster. And if anything is going to sort of kick up this flat trend, it's going to be the power generation market, because it's a green fuel, and nobody wants nukes, nobody wants coal, and so you're going to see that increasingly at the margin be movement. But it's going to take time. Okay, you're talking 2009, 2010 before you really start to see that really sort of kick in a really more meaningful way. Industrial, I've got the sort of sideways arrow, meaning it's been flat, but that's only been in the last year to 18 months, which is good because it's arrested a big decline. Okay? Because the rise in power generation was largely being counterbalanced by a drop in industrial, a fairly aggressive drop in industrial. That trend in the last couple of years has sort of leveled off. So I would say to you that, okay, the flat demand situation has probably played its course, especially now that we have relatively cheap gas. I think as you go forward, you're going to see the demand start to pull up, even in North America, but it's going to take a little time to get that kind of acceleration that you see in the other markets of the world that I showed you. Okay, so the signs are positive, but if you want to know what's wrong with it today, it's largely been flat. The U.S. supply response. This is probably the number one thing you need to understand, the number one thing that is contributing to our issues here. So here's a picture of North America. So these are the trends from 2000 to 2006. The Western Canadian Sedimentary Basin. I have it going up. In fact, it's been up and down, as I showed you on that pipeline receipts chart. The last, I'd say from 2004 to 2006, it was going up, but post-2006, it's starting to fall again, as I showed you. The Rockies has been climbing, and I'll show you that in a minute. West Central was gradually going down, following a long-term decline because of the maturity. West Central includes Texas, Arkansas, Oklahoma, and Louisiana onshore. Okay, this is just to 2006. Okay. And the Gulf of Mexico was exhibiting really steep declines up to 2006. So let's take a look at the U.S. supply regions. What's happening now is that the West Central is going up aggressively. Okay. The Gulf of Mexico, the declines have been arrested. The Rockies continue to go up, and our basin is going down by a little bit. Okay, so it's been a real reversal. Let's take a look at the data. Rocky Mountain area production. You can see that it's been on an uptrend. This is the non-conventional gas that has been on the rise, and the technologies that have been applied to it. And it's a good, steady, long-term growth story that's gone from 6 BCF a day to almost to 9 right now, and climbing. It's climbing at a rate of about half a BCF a day per year, okay? And we expect it to continue on that trend. The U.S. West Central area, so this is Texas, Oklahoma, Arkansas, and Louisiana onshore. From 1998 to 2004, you can see kind of choppy, but on a downward trend. It was really following a long-term downward trend because of the maturity of those things. I mean, continentally, we've been exploiting natural gas for 100 years, so this should come really as no surprise. Right? The conventional stuff is basically in sort of extreme maturity. It's really then again now the unconventional stuff that started to rise up again from things like the Barnett Shale in Texas. And so the big event really, 05 to 06, is a big addition in production there. And if you look at what's going on in the trends, that will continue, though we'll start to, the acceleration of that growth is probably going to slow down and probably even flatten out by 2010. But let's take a look. What is it that is driving that trend? Because it's so important to understand. The blue line is basically the same chart as the previous chart, except it's monthly data instead of yearly averages. The red is the implementation of horizontal drilling. So the blue line, again, up to 2006-ish, shows sort of that gentle decline, month-to-month variations, but sort of on a decline. The horizontal drilling activity, and you can take this further back a little bit, but basically about 6% of all the wells drilled were horizontally drilled. But it was really the application and new technology, including fracking and completion technologies, and the horizontal drilling in the Barnett Shales and things like that, where the drilling really started to kick up as they saw successes, and you can see the trends basically overlay. Right? So a classic story of new technology coming in and improving the economics of the geology and kicking up production. And this is substantial. I mean, look at the scale on the left-hand side. If you 23 BCF a day to 26 in a relatively short period of time. Okay. This is a big story. Like, a lot of people are pointing to low gas prices and saying, oh, it's LNG coming in. Okay, I'm going to show you LNG in a minute. But LNG comes and goes, right? This is more of a sustainable trend, right? And between this and the Rockies, there's a real supply resurgence coming. And I'll show you the big picture here in a second after I show you the Gulf of Mexico, where the gas production was level between 98 and 2001, around 14 BCF a day. Then it went into really steep decline, and all the way down to 8 BCF a day by 2006. This was the kind of thing that people said was going to sort of continue, but there's sort of a let's call it a rush or a gasp of new production that's coming on with something called the Independence Hub that was put on production here a couple months ago, and will ramp up its production. What it's doing is really arresting the declines for the moment. Okay. the Gulf of Mexico will go into decline again in 2009, probably, and 2010 again. But suffice to say that this sort of broad, aggressive trend of declines has been arrested for the moment. So what do we have? The Gulf of Mexico is arrested. The West Central is producing substantially more, and the Rockies is continuing to contribute and will contribute more as the new Rockies Express pipeline comes on in January 2008, here in a few months. So here's all other regions, the Californias, New Yorks, and all the other regions of the U.S. It's basically pretty flat. It's the other regions that are at issue. If I expand the time scale to 1973, now look at total U.S. natural gas production. Okay, the total U.S. production. It looks something like this. 73 to 83. Sort of step down and decline. This real turnover here was really the offshore Gulf of Mexico really coming on. And so from the period of the mid-80s to the mid to late 90s, basically what you had was a rise of about 10 BCF a day in gas production by virtue of all that offshore stuff. But then it went into, rolled over and went into decline, and I showed you those decline charts. So, if you think about this century, from 2000 to today, or 2000 to 2006, sort of we got accustomed to this idea that the whole of North America, the gas regions have matured and they're not going to come back up again. Well, that's actually been reversed by virtue of what's been happening in the unconventional regions and the application of the new technology in particularly the West Central region and in the Rocky Mountain region. So the forecast is for it to go up again, and the domestic production probably not rolling over until 2010 again, when the Gulf of Mexico really probably starts to drag it down. Okay? Number 3, LNG. We've heard a lot about LNG, and it is a very complicated subject. Okay? So what's been happening is that, yes, these tankers have been coming over fairly aggressively, especially this past summer. The average amount of LNG that came into the United States was about 1.5 BCF a day, on a total average of 68 BCF a day. So it wasn't all that much. But this past summer there was up to 4 BCF a day that was coming in. More terminals are getting built, and more is expected to be able to come in. Okay. The intimidating chart is this one, and I apologize, it's a little bit busy, but we've got from 2000 to 2015. There, the vertical red line is 2007 to 2008. That's basically where we are today. So in the United States, there's about 6 BCF a day of total capacity that you can see between what's being constructed, what's approved, and what's proposed. By 2012, there could be like 53 Bs a day on total consumption of 68. So it's just an outrageous amount of capacity that's scheduled to come in. Now, all of that will not get built because, as I like to say, if you build it, they may not come, right? And I would suggest that, in a nutshell, given what's going on the other side of the world, I don't debate that a substantial amount of this build in the near term is going to come online. Like it wouldn't surprise me if we have, another 8 B a day capacity come in. So when people say we're going to get a surge of LNG, I say, well, maybe. But nobody ever says at what price it's going to come in. Like, what price is it going to come in at? The notion is it's going to come in at $3 or $4 an MMBTU. Or something, and clobber our prices down. And I would debate that. I think that with oil prices rising globally and the people who own the natural gas globally, which is the same cast of characters that have a large portion of the oil, they're not interested in giving their gas away. But let's explore it a little bit further here. Now, why is it that all this LNG came our way? Well, basically, there's an LNG market that's emerging. Now, LNG is not like oil, which is a globally traded commodity, which is very well established. There's a futures market, and arbitrages between world supply and demand points get worked out very quickly. And that's started to happen on the natural gas side. So really what's happened is that when prices were, moderately okay, running $7 this summer in the United States, and they were really depressed in Europe, well, the tankers just decided to come to North America. The capacity was available to take it. Right? Today, when the situation's already reversed. The price of gas in Europe is $8 or $9, and it's $7 to $8 here. The tankers aren't coming anymore. In fact, today, the LNG shipments on a daily basis are less than 1 BCF a day, which is lower than the average. So I said it comes and goes, and it's going to depend on the price, which depends on the global weather, which is very hard to predict. But, as you look forward, what is it that's going to drive it? Well, it's going to be the transatlantic price differential, and it's going to be the trans-Pacific price differentials as the LNG market emerges. And if we think about, China on the other side of the world, and we look at the Asia-Pacific region, existing or under construction LNG facilities, it looks something like this. The blacks are the existing, the reds are under construction. You can see Japan on the top right. I haven't put Japan because it would just be a big blob because they have so much LNG. And they're building more, by the way. But this is what it's going to look like here. There's like 38 new proposed LNG. So it's not only the U.S. that wants the gas, it's the other side of the world too. And by the way, they're growing their demand at a much more rapid pace than we're growing ours. Okay? And we see deals now in India where the gas is being contracted at $10 and $12 per MMBTU. Okay, so there's this huge arbitrage. It's a relatively immature market globally, but by the end of the decade, I would suggest to you that this global market for gas is going to become more liquid. It's going to become, the arbitrages are going to be less, and the global price of gas isn't going to be cheap. Why? Because there's this industrial revolution and the breaking point on the other side of the world. And so, yes, if we build it, they may come, but at what price? And I would suggest to you not at as low a price as people are thinking. But we're going to have to wait for that. Have to wait till probably 2010, 2011. 4, distant and concentrated markets. Well, one slide here. I just want to point out to people that the continental pipeline artery network looks like this. The red dots are the major hubs where the gas is transferred and traded. The gray are your arteries, the width of the artery proportional to the volume of gas delivered. If you take the artery in Canada and especially go west 5 and into northeastern BC, you can basically see that we're at the end of the pipe. We are the furthest away from the markets. And now that we have tremendous activity in Texas, which is actually rather close to the major arteries and can get to the markets rather quickly, the bottom line is we are in a rather uncompetitive position. Right? Because our transportation charges are more, and further to that, our arteries reach into the Midwest and the East, and we are completely hostage to the weather in those cities, which is rather unfortunate because we tend to now run our boardroom strategies by watching weather maps rather than thinking about the business issues. But that's the reality, is that we are at the end of the pipeline. There's more gas coming on in the U.S. that's closer to market, so we are less competitive than those other sources from more perspectives than one, and geography is one. What's wrong with Canadian gas? The cost inflation. Well, when the price of oil was up high, and all the geopolitical issues and other things that I mention in my book, things like that, is it any wonder that all this money comes pouring into the oil sands? Right? Well, that's what the profile looks like in terms of the investment pace. What was 10 years ago $3 or $4 billion in investment per year, which was rather manageable, has now turned into $15 to $20 billion a year of investment. Between now and 2015, notwithstanding royalty review, etc., just the majors alone will spend $160 billion. Well, that's a huge amount of money. Right? Almost $20 billion a year going forward. When in Canada have we had such huge infrastructure build? I suggest the last time was probably like the James Bay hydro project, which I think cost $20 billion in total. This is $20 billion a year, right, on a population base of 3 million people. So is it any wonder we have all these societal stresses and strains and basically inflation that radiates out of here and affects not only the film industry and every other industry which is having difficulty getting cheap labor, but also the natural gas business, whose costs have also really risen, whether it's operating costs or steel costs or anything else costs. So here, as an example of many weekly earnings of Alberta oil workers in the field, which I think if you translate it now is over $80,000 a year, I think. Well, equipment prices have been coming down. by virtue of all the inactivity on the natural gas side, bearing in mind that 70 to 80% of all wells drilled are natural gas wells. And, we've seen this cycle before. As the rigs go home, the prices come down. But, drilling and completions is not the only cost component here in getting a well online. There's a development facilities, a gas plants, land bonuses, G&G, and so on. Well, the development facilities are hostage to the same issues as the oil sands. So getting people, welders and pipe fitters and whatever else, is difficult. And on the drilling side, the average wage has gone way up with the workers. So the cash flow break-even point of that business is up. All of which is to say is that, yes, prices have come down for certain services in certain areas, but they're rather sticky. Right? They're not coming down as much or as fast as they would have historically. So the threshold economics are much higher today than they were before. And we've got this stickiness that's occurring by virtue of sort of what's going on in the province. What's wrong with Canadian gas? The Canadian dollar is sort of great for vacationers and cross-border shoppers, but the relationship is rather disturbing, I guess maybe we'd call it, whether it's for the gas business or any manufacturer. Well, for the gas business, here's the story. This is the Canadian dollar. 85 cents only in February, and now it's $1, $2, or $3 or something like that. Well, the relationship is that for every penny rise in the Canadian dollars, you lose 9 cents a GJ. Okay, so 9 times the 18 cents or 85 to $1.03 translates into $1.65 a GJ that we've lost just because it's just a tremendous amount. Our gas would be well over $7 today were it not for this Canadian dollar effect. So when is the Canadian dollar going back down? I don't know. Right now the momentum is up. And I don't think it'll last, but it'll last potentially long enough to make the pain in this business last longer, right? Or last, potentially for a year or two. So this is a big issue for natural gas producers. It's equally a big issue for manufacturers across the country as well. And were it not for this, we could have probably kind of squeaked by, but this really sort of throws it over the edge. And speaking of throwing it over the edge, well, I guess we've got policy shocks as well. We had the trust legislation, which raised the cost of capital, and financial markets are less willing to commit risk capital here. And now we've got the royalty review, which has really exacerbated that, even with the inaction and the uncertainty. And so where is it going to land? I don't know, but it is really an inopportune time to be raising royalties on natural gas right now because it's really suffering from all these issues which are really serving to make the whole industry very non-competitive, even without the prospect of raising the royalties, even without the prospect of raising royalties. Okay, so given all that I've told you, what is the outlook? Okay, we've got a very bullish situation that's emerging on the other side of the world for natural gas, a global gas market coming around, the potential for U.S. supply to sort of roll over eventually, but the outlook, if you piece it all together, and notwithstanding some caveats, in other words, wild cards, which I have no real sense of, is the weather. I'm not a weatherman, and it's not only a localized weatherman, it's not even a weatherman who understands Boston and New York anymore. You've got to understand the world weather because what happens in Korea this winter is going to affect how much LNG is and what happens in Europe, etc. So, I have no control over that, and it could either things all of a sudden look more bullish, or they can exacerbate the problem. Aggressive oil price rise or fall. I'm a bull. I think the oil price is going to keep rising, so that's good news. It will drag up gas, but one can never preclude a fall either, and that could go either way. But I would say I'm certainly more certain about the oil than I am about the weather. A volatile loonie, if the loonie does go south and go under par, we're going to recover some competitiveness by virtue of that. But the way it looks right now, I wouldn't hold my breath for the next several months. The Alberta Royalty Review, we will find out on the 24th what that will do to the industry. But it looks like it is... in its current form, it's a burden that really the industry cannot bear at the moment. Okay, so the probable outlook, to sum up here, I've put a timeline on the top. Q4, which is the quarter that we're in. In actual fact, it looks there's a sign for optimism actually on a short-term basis. Some price buoyancy as we head into the winter heating season. That always happens, but we're actually looking like it could be a colder winter than 06, 07. I'm not the weather person. I'm just sort of regurgitating what other weather agencies are saying. But if it does pan out, it will serve to give price buoyancy. Oil prices too will help the buoyancy a little bit, but I wouldn't get too excited because the sustainable support is probably going to be lacking. Okay. What I'm really looking for is sort of the non-seasonable support that gives sustainability to our business, because we don't want to be hostage to this sort of up and down and up and down. When is it that we're going to get sustainable support for the economics of this business? 08. Again, oil prices I think will offer support, but the net supply-demand balance for the gas in this continent is likely to be in a surplus of about a BCF a day. In other words, the incremental supply from the U.S. basins put against sort of the declining supply in Canada, and all things considered, assuming sort of average weather patterns, it looks like we're going to be in a 1 BCF. In other words, the probability is biased towards the supply side in 2008. LNG, more capacity is coming on, and again, it depends on the weather and those cross-Atlantic differentials, but the real message behind all that capacity coming on is that it's going to cap any price spikes. Okay, we've sort of gotten accustomed to these price spikes in the winter and summer, and so the real impact of LNG is a spare capacity that will clip. It's like it'll clip the price spikes. So unfortunately, I can't honestly say that 08 looks a lot better than 07 because the supply bias doesn't favor a significant price bias. But bear in mind that there are all these caveats that I throw out there. But all else being equal, I'd say there's a 65-35 chance that there's 08's not going to look that exciting. 09 and 10, Canadian production still in decline. U.S. gas production, I think by 10, will start to level off. Global demand growth continues to accelerate, which will be bullish. And the world gas market starts to globalize more, greater liquidity and price strength globally. The arbitrages start getting worked out more, even potentially the emergence of an LNG futures market. So I'm optimistic that you get some sort of price traction starts improving to offer some sustainability to the support. As you go further out, total U.S. production in decline again, 11 to 15. Global price strength momentum. So that market establishes itself. The demand growth continues to accelerate as there's no option on the other side of the planet as to go aggressively into natural gas. And the supply issues surrounding natural gas start to, I think, manifest themselves. So the geopolitical issues of gas start to show themselves, and that actually may come earlier than 2011. It could come a lot faster than we think, especially if the situation in the Middle East starts to heat up some more around Iran, which is the second largest reserves of natural gas. And the Russians, of course, with the largest reserves, are not shy about using gas as a political tool as well. So I say natural gas is going to become the new oil in this period. In other words, go through the same sort of pressure and tensions and things that we saw with oil starting a few years ago. And so structural strength will probably start driving the market. So that's why Canadian gas is the way it is today. That's my outlook. What does it mean to you as we operate in this basin? Well, it means we need to regain our competitiveness. Right? And as I said, this is not something exclusive necessarily to natural gas. It's every industry in Canada that is exporting has this problem. Right? Competitiveness is usually manifested or mitigated, or enhanced by new technology. So the technology, you saw what it did in Texas. All of you in this room as geophysicists are technologists. And more than ever, I feel the technology and the geophysics is going to be really important in re-establishing the competitiveness of this business during a fairly difficult time here in the next couple of years. But those who view the world as pipeline half full rather than pipeline half empty, I would say will be rewarded. Okay? You will be rewarded because this is a time, if you think back to your experience in this business, like when is it that the fortunes have been made? it's been made when people take risks and view down cycles as an opportunity rather than something that is misfortune. So I guess my challenge to you is that you are an integral part of making oil and gas companies competitive. It's more important than ever, and the challenge is to find creative ways to do that going forward. Thank you.